Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Sonesh Shenoy and Pavitra Parekh. Down 12 points on the Nifty. We've snapped a two-day winning streak, but we're off 70 points from the day's low. The recovery in the last 1 hour has been pretty sharp. The Nifty Bank is now back in the green, so it's up 34 points on the Nifty. Again, the cuts to begin with were not as bad as what we had in US markets overnight, where the key indices were down close to about 1.5%. And now look at the up move that we are seeing, particularly in the banking space, which is fueling the rally in the Nifty. So trying to break into the green now. It's the weekly options expiry today, and it's also going to be an earnings-heavy day. Asian Paints, HUL, Emphasis, L&T Technology, Havells, PVR, Canfin, Homes, AU, Small Finance Bank. The list is very long on that.
You can breathe a little bit, Reema.
So, IT stocks, once again, are showing a fair amount of resilience. The Nifty IT index is in the red, but again, not as bad as what we've seen on NASDAQ overnight. Typically, through all of 2022, if the NASDAQ fell 1%, the Nifty IT the next day would fall 1%. But today, the Nifty IT index is holding up. The banking earnings continue to be very strong across the board, across private sector banks and the PSU banks. There hasn't been a disappointment on the banking numbers. The latest, of course, was Indices Bank, which reported numbers. Indices Bank is in the red right now, but the numbers were very good. And the private banks like HDFC Bank, Indices, Federal Bank, PSU banks like Central Bank, Bank of India, Bank of Maharashtra, which reported their numbers, all of them have been very good. Everyone's been saying it's the positioning, which is why the Nifty Bank has underperformed. The stocks aren't reacting to the numbers, but purely on numbers, the banking earnings across the board has been very solid. Some updates coming in on Newgen Software and non-deal roadshow on the 19th and 20th of Mumbai, today, tomorrow.
Well, okay, lots to reckon with, right, this morning. But I think the moot point really is that this market is showing a lot of resilience. It's gained, over 400 points from the lows that we saw in December. And even today's dip, despite all the bad news that we've got from global markets, the dip has gotten bought. The market is now almost in flat terrain, which indicates that maybe, just maybe, the worst of the recessionary fears are now behind us. We've covered quite a bit of ground. This 18,250 to 300 mark is where the resistance could kick in, because that's where the downfall began in the month of Jan. The other good part about the market is it's rewarding a lot of good news in terms of earnings, not just persistent systems, but you see the earlier earnings, whether it's something like a Metro Brands, which did very well with its numbers. That's putting on some more weight this morning as well. Cyient has gained almost, 15% this month already, been one of the big movers. So this market is in a mood to reward a lot of good earnings, and that's the, the other positive thing. I guess, you have a lot of data coming through from the US as well later today. There are still recessionary fears, but give and take everything, the bulls have covered a lot of ground. So let's see how the second half goes.
Let's see how the second half goes. In fact, the recovery you were talking about, that's something that's playing out in the rest of Asia as well, right? I mean, Nikkei is seeing sharp cuts, but barring that, everything has seen quite a good recovery. So take a look at Hang Seng. It's now around 45 points in the green. When we started the day today, it was around 200 points in the red. So there's been quite a recovery over there. Shanghai, Kospi, all in positive territory right now as well. So there has been a recovery that's playing out across Asia. For our own markets, it is some of the PSUs that are holding up today, in addition to the banking names that Reema mentioned. So you have ONGC, Power Grid, Coal India doing well. The entire HDFC group of stocks holding up quite well. On the downside, it is FMCG and metals, which are seeing some cuts. But, they did see quite a run yesterday as well. So do keep that in mind. And the entire Adani group of stocks under pressure. So those will come up for you. Adani Enterprises is down over 3.7%. You have Adani Ports, Adani Green, all of them seeing sharp cuts. In fact, for this week alone, Adani Enterprises is down almost 7%. You have Adani Ports, which is seen near 5% cut. So this is a space that I would watch. And like we were pointing out, there's lots to watch in terms of earnings that will come through and also data. So we are going to watch that closely. But to kickstart the show, let's get a conversation going. And we have Nitin Bhasin joining us. He's head of equity research at Ambit to take some questions now. Nitin, good morning, and thank you very much for joining us today. This is Pavitra. We've already seen quite a shaky start to 2023. There has been a lot of, volatility in markets, which is played out and is reflecting in our own markets as well. How do you think it's likely to pan out, at least in the medium term? We have that huge trigger coming through in, in the form of the budget, and also, of course, the earnings season is underway as well. So how do you think it will play out, at least in the near term? Do you think this volatility is likely to persist?
Hi, good morning, and thanks for having me for the show. I agree with you that, how we perhaps see the next 3 months, there would be more volatility in the market. Though in the beginning of the year, when we wrote the note about how do we look at the market, we think there's a fair valuation of an 8 to 10% upside if one was to think for the year. For the next 3 months to 6 months, we're going to see one of the big changes in the Indian market, which is the domestic flows. Whilst earnings have an impact on a near-term basis, but the last year, what we also saw is as the FIs were perhaps selling in the first half, the domestics throughout the year, especially the flows, held strong. And what we are noticing now is beginning of some sort of a softness in the flows from the domestic market, especially because either the last 12-month returns of the market, or secondly, the rising interest rates in the deposits perhaps impacting. So as we go through this earnings season and as we go through this shift in the DI flows, especially from the savers, that would create volatility at least for the next 3 months. And add to it what's happening into the US, the entire talk about recession perhaps in the US or the other developed market. So volatility will remain high.
But I guess volatile times are the best times when you get opportunities, right? Especially in the stocks that you like, and the best time to make money. So I wanted to ask you, Nitin, a little bit about the buzzing stocks. I mean, Persistent Systems is really gaining now. And if you look at the price action of, if you pull up, say, 1 year chart, it's still way off its 52-week high. The 52-week high of Persistent Systems was almost 5,000. Do you see more upsides now here for some of these mid-cap IT names post their earnings?
So about 1 year back, our point of view was that the IT sector is not the place to be in. And we were underweight, advising investors underweight for IT, let's say about 1 year back. But for the last month or so, given the relative underperformance of the index, especially the IT index, to the overall market, our call has been that investors should start adding the IT sector with a little bit more towards the large cap names than the mid cap names. Mid caps as a space overall, we're pretty much not so positive for the next 6 months to 9 months. So IT has been one of the sectors that we've said that we should be adding more within that. And why so? Because A, the relative underperformance, and B, perhaps the earnings downgrades have stopped now for the last quarter or so. You saw the September quarter numbers, you're seeing this particular quarter numbers, whatever has been come out, the numbers are holding up, no more downgrades right now. And I think a number of domestic investors have moved from under ownership to, let's say, an equal ownership. So where, so hence, and the relative valuation discount premiums have also off a lot. So hence, I would say IT is a place to be in, rather than specifically talking about a particular stock.
Nitin, can you talk about your call to reduce banks to a moderate overweight? Because the earnings so far have been resilient. Is it just the expensive valuation, the recent run-up, which makes you a bit cautious? Or are you sensing that come, say, 1 year down the line, 6 months down the line, the earnings could start getting a little more compressed compared to what consensus is expecting?
Sure. So 1 year back, at that point in time, the relative underperformance of the sector to the overall Nifty was pretty much very high. And at such levels, we've seen that the banking sector lands up giving very good returns over the next 6 months to 12 months. Today, relatively, the underperformance, no, it has actually materially outperformed the market. So you are carrying a baggage of a good performance, number one. The valuation discounts have actually converged to the overall market. But more importantly, what we've seen is the NIMs of the top 11 or 12 banks posted very strong numbers, closer to about 3.5% in the 1H FY23. We think that 2H FY23, you'll see a repeat of that. But as we go into the next year, the cost of funds will start having some sort of a bearing on the overall NIM margins of the entire sector. So perhaps that is the reason that we see that whilst today may not be the reason to go equal weight or underweight, one should remain slightly overweight, but mostly in the banks, and that too in the large banks, including 1 or 2 of the leading PSUs. So it's basically about maintenance of earnings, but next year the NIMs could come under pressure, mainly because of the cost of funds. Hence, we're reducing it from a massive overweight to a moderate overweight.
All right, got it. That is on the banking space. Nitin, you were mentioning, the China reopening that is playing out right now. Do you think in that light, the metals pack is, still good to get into and good to put some fresh money into? These stocks have been rallying hard. But, this kind of information is so closely hinged on what's happening in China. Even the OMCs, pretty much all of the commodity plays move like that, right? So do you think that this is still a good time to be getting into these? And if yes, then what within the metals pack would you look at?
Within the middle pack, what we've added to our portfolio is a Tata Steel or a Hindalco. These are the two names that we like from the metals pack, large names right now. I think it is one of the plays on the China opening up trade, but also remember they've gone through a lot of price correction in the last 3 months to 6 months. You are also seeing a massive differential between the overall contribution to the from the metal sector to the profits of the market versus the market cap that these stocks enjoy. And remember, these are actually operating at one of the lowest debt equities ever, closer to half right now as an index. So you've got a good balance sheet support. You've got an opening up from China. And more importantly, the stocks are actually giving you not a very expensive valuation to enter into. So hence, metals is one of the sectors where we are indicating between these two names, whether it's Tata Steel or Hindalco, to be in.
Okay. I wanted your thoughts also on how to approach the real estate names because, you know, there was a very interesting note that Motilal Oswal put out this morning where they spoke about how the real estate residential sales are now at a 9-year high. And there are so many of these companies, right, whether it's Lodha, Prestige, Brigade, they have a slew of new launches across most metros, whether it's Mumbai, Bangalore. Wanted to understand, is there any upside from a stock perspective and which are the pockets that you'd like here?
We continue to cover a few names in the real estate space, and our entire view on the sector has been it's not the about affordable housing. It's basically the premium housing property developers which are the ones to be in, whether it's an Oberoi or whether it's let's say a Brigade. These are the kind of companies that we like from the particular sector without giving any specific ideas. What we see is there is a massive change in India happening in terms of the age of the home loan borrowers or the home buyers. We're becoming more and more younger. So the companies which are actually a good play on younger borrowers, younger buyers of housing, perhaps those. And these are perhaps centered more around the cities which generate a lot more employment. Let's say a Bangalore market, pockets of the outskirts of the main market of, let's say, a Delhi or a Mumbai. Not so much perhaps the growth in the volumes will come from in the next 1 or 2 years from very heavily priced, high, large products or large flats. So those are the kind of companies one should be looking at. But at the same point in time, I would also like to add over here is the next 1 year may not be one of the best times for multiple mid-cap sectors. And, real estate is a very big mid-cap sector or a small-cap sector. When we are giving a fair valuation to the index or giving particular recommendations of sector calls, in the asset cohort size, we are also indicating that mid caps or small caps, those small caps have gone through a price correction in the last 1 year, is not the place to be in. One should be more overweight for institutional clients into the large cap names rather than the mid cap names.
Nitin, pleasure having you with us on the channel. Thank you very much for joining in. By the way, the Nifty's once again dipped into the red, down 35 points. ICICI Bank is weighing on the market. So ICICI Bank has seen a bit of a slip. In fact, HDFC Bank's outperformance versus ICICI Bank continues. So today, HDFC Bank has moved to the high point of the day. It's up 0.5%. But on the flip side, ICICI Bank has seen a bit of a sell-off, and that stock is down 0.75%. And this week itself, HDFC Bank has outperformed ICICI Bank by nearly 4%. And even in the last 10 minutes, that outperformance is getting a little more stark. Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in as always.
Welcome back to Trading Hour on CNBC-TV18. Well, for now, the market is inching up to almost green terrain. I think by the time we end this show, the markets would be in the green. And that is commendable considering we had such weak cues to begin the day with. But let's focus now on the commodity space, and to get you your hot brew this morning, Manisha is joining in to talk about coffee and some other softer commodities as well. Manisha, over to you.
Oh, well, yes. Thank you for that, Sonia. I have the top gainers and losers in soft commodities on my list today, and a major decline clearly coming in for the coffee prices, which is now trading at 1.5-year lows. And that is because the weather in Brazil has improved, and the expectations now are that the Brazil crop could be 16% higher in this year at around 65 million bags. That clearly has weighed on the prices. But other soft commodities have seen some strength as well. Within the edible oil sector, it is the soybean prices now trading at a 7-month highs. There is strong demand as China reopens. China, by the way, is the world's largest soybean importer. We did see soybean prices gain up by 12% in 2022, and 23 has opened on a firm note as well. And a smart rebound is what we are working with for the rubber prices also. The international markets are now trading at a 5-month highs. Remember, China accounts for 40% of natural rubber of global consumption, and with China demand coming back, there is support here. Also, China vehicle sales are expected to gain up by nearly 5% in this current year. That is where rubber is taking support from. And then there is a report from International Rubber Consortium saying that the output is expected to increase in this year, but not to a large extent from the major producers like Thailand, Malaysia and Indonesia, and that clearly has been supportive.
All right, Manisha, thanks a lot for getting us an update on all of these soft commodities. With that, we're going to get into a short break on the show, but when we come back, we'll shift focus and we'll talk about the market technicals. Kush Bora will join us. Hey guys, welcome back to Trading Hour. We are currently seeing around a 50-point cut on the Nifty. The Nifty Bank is where you've seen the losses widen a little bit, so it's around 150 points lower over there as well. Take a look at something like an Axis, which has slipped quite a bit. ICICI Bank at the low point of the day. So these are some of the stocks which are exerting pressure on the Nifty Bank. What has actually moved up a little bit in the past few minutes is Reliance Industries. So that one is absolutely flat right now, but it has seen a significant move from the low point of the day. Remember, Reliance will post earnings tomorrow as well. So ahead of that, right now, it's absolutely flat. But let's get you a technical check on the market. Kush Bora joins us for exactly that. Kush, good morning and thanks a lot for joining us. You know, considering the kind of global handover we've had, we definitely opened in the red, but we have seen a decent recovery from there. How do you look at it there? And I mean, it's looking pretty resilient, right? In that context, around a 50-point cut is not that bad.
Well, first off, thank you for having me on the show, and I'll give you a couple of factors to just support what you just said. Well, I remain bullish in the markets for the near term, and a couple of technical factors just to support that point are that there's a very clear RSI divergence on the Nifty. Second, the more number of times we test, but we don't break the 17,750, 17,800 support zone, the stronger it gets. So for me, there's an immediate buy on Nifty for a target of 18,300, 18,400 kind of levels, and 18,000 would be my strong stop loss. Maybe not today. It's a positional bet. Today is the weekly expiry, so that hangover will play out. On the Bank Nifty also, I remain extremely bullish. I wouldn't be surprised if positionally, there is a move towards the 44,000 mark in the coming months on the Bank Nifty. A couple of reasons here. First, the support of 41,500, 42,000 is playing out very well. Second, the results that are coming out are extremely encouraging. Now, the only two factors that I feel that are holding the Bank Nifty back are the FII outflows and the budget expectations. So once the budget is over, post that, I think, the Bank Nifty could start a new hike towards Mount 44K. On a more immediate basis, 42,800 is my target on the Bank Nifty, and 42,000 is where I have the stop loss on Bank Nifty.
All right. What about individual stocks then? What are you looking at? Kush, welcome to the show. Suddenly from being, the much hated sector, IT has once again become the darling of the market. I guess that's how the tide turns, right? Very quickly in the market. Do you like any of these stocks?
Well, I do. Well, and as they say, in hindsight, we're all geniuses, but that's how markets sort of humble you. There have been times when IT has lost flavor, but it's sort of coming back. I won't be too gung-ho about the IT sector, for let's say a couple of quarters. seems more like a trading play right now. So HCL Tech is something that I like in the IT space. As far as the other stocks go, Tata Steel was my last call for 2022 for a target of 116, and that seems like a distant history now, doesn't it? So and I continue to remain bullish on the metal space. So Tata Steel will continue as a call. 130 is my target on this, and 120 is the stop loss. HDFC Bank, I was listening to Rima talk about HDFC Bank's outperformance, at least today versus the ICICI Bank move. I think this is only the beginning. This outperformance will continue. It's coming out of a slump. So I think the move will continue. I won't be surprised to see 1725 levels on HDFC Bank. But for a more immediate basis, 1675 is my target, which is a recent swing high, and 1625 would be my stop loss.
Thank you very much for that. Need to slip into a very short break. Up next, we'll discuss market fundamentals. Siddharth Khemka, Motilal Oswal Financial Services joins us next. Welcome back. Siddharth Khemka, the head of retail research at Motilal Oswal Financial Services, is with us now. Siddharth, it's been about 10 days since the earnings season began. Could you give us a sense how it's played out? Have we seen, on the whole, EPS upgrades or downgrades? It's largely been between IT and banks that we've seen the numbers come through. And where is it that we've seen a positive surprise that you would recommend a buy because the valuations still are attractive?
So very good morning, Rima, to you and to all the viewers. So yes, largely the result season has till now been centered around the IT companies and the banking stocks. Some of the bigger other banking names that will come out results, ICICI, Kotak, would be towards the end of this week. But so far what we have seen is overall the results have been in line to better than expectations, not disappointed the market so far. Usually the culprits, or you can say, they come towards the end of the quarter season, which can drag down the overall earnings. But as I said, so far not disappointed the market. IT has been actually surprised the market with in line to better the results. Some of the companies have given out even upped their guidance. For example, Infosys upped their revenue growth guidance, and margins have been pretty better to in line with expectations. So I think IT as a space definitely surprised the market on the higher side. The street was discounting weak numbers. The outlook for the next 2 quarters continues to remain hazy. But what remains pretty good is that the long-term outlook for IT continues to remain strong. Deal order pipelines is pretty strong, and that should lead to long-term outperformance from the IT players. As I said, near term, there could be some weakness. There are the fear of the US recession, European slowdown that could keep some of these stocks under check. But from a long-term perspective, we are positive on IT. We are recommending top picks from the IT space are Infosys, TCS, HCL Tech. Coming to banking, I think results so far have been strong. HDFC Bank, Indices, we had some of the smaller banks, Federal. Overall, the expectation from the banking space is that it would be the single most sector which will drive the earnings growth for corporate India in Q3, and led by some of the PSU banks where the delta is even higher. So overall, I think banking would continue to do well. We are seeing credit growth being pretty strong. So core business is something that is driving the banking space. Provisions as well as asset qualities both are under control and looks pretty steady. Valuations are you can say spread across the space. Some of them are pretty attractive. Say for example, Indices, there were still concerns on its niche segments, be it microfinance, be it the vehicle finance, but that is showing stability now and showing signs of improvement. While on the other side, Axis is another one where valuations is still comfortable, and we are expecting good numbers. Stock has corrected in the recent past. We see good upside on these two, apart from the usual heavyweights, the ICICI, SBI and HDFCs of the world.
So there is, a common narrative playing out, right, where the expectation is that money could move out of ICICI Bank and into HDFC Bank, and HDFC can correct its long-drawn underperformance. What are your thoughts? Would you go with that, and how are you approaching these two names now, apart from Axis, of course, that you spoke about?
Yeah, so I think if you specifically look at HDFC, there has been some kind of underperformance. We have already seen some money moving out of ICICI into Axis. But now, yes, there is an increasing interest towards HDFC Bank. With the merger now coming closure yesterday, there were some news flows regarding how the merged entity could see some more inflows from MSCI, some of the FIs that could increase weightage post the merger. And I think that is driving the short-term performance. But as I said, if you have a long-term fundamental view, I think HDFC is doing better, but still valuations are fair. They are no longer in the expensive zone. Outperformance, we are seeing more from something like an Axis and Indices. So it's like a performer rating for us on HDFC Bank.
All right, got it. Siddharth, any new stocks that you've identified that you feel like right now is a good time to perhaps get into? Any new ideas?
Yeah, Pavitra. So what we are looking at is a kind of a manufacturing theme that we believe could do well in the current calendar year. Even with the budget approaching. So Bharat Forge is one of our preferred picks to play that manufacturing, or you can say the capex theme. The company had a recent analyst meet where it highlighted that the core business have been stable both in terms of India business as well as in exports. They are planning to launch several new products in the EV space over the next 12 to 18 months. Plus, over the long term, the vision beyond 2025, the company is looking at several new technologies, including alternate fuel technologies, be it the hydrogen fuel cell-based powertrain solutions, advanced electrical engine chassis, some of the carbon fiber components, sodium-ion batteries, which will drive the long-term growth. In the near term, we believe that defense is now fully ready for Bharat Forge to take off. They've already won orders for armored vehicles from the Indian Army, and they are now expecting orders for artillery guns, which should be they should be getting it by March, April of this year. Also, defense exports is something that they are looking at specifically for the gun segment, and they are looking at orders from the US segment. So overall, we feel that Bharat Forge is now entering time of harvesting whatever they have invested so far in terms of some of the other non-auto businesses. These businesses will expand the addressable market and provide good growth in terms of profitability.
Thank you very much, Siddharth, for joining in. Get into a break. On the other side, we'll get you excerpts from our exclusive conversation with Roshni Nadar Malhotra on what is her first interview since she took over as the chairperson of HCL Tech.
Welcome back to Trading Hour. Continuing with our special coverage from Davos, HCL Tech chairperson Roshni Nadar Malhotra spoke to Shireen Bhan in what is her first interview since taking over the reins at the tech giant. Listen in.
If you were to, speak to us in December, we had a lot more nerves. And I think a lot of the conversations since then are that companies are still going to go through the digital transformation and the necessary spend. And there are always going to be opportunities, there are vendor consolidation opportunities. There is some slowdown in some discretionary spending, but I think that again is much more of now a short-term issue, and we hope that the momentum will actually continue.
You spoke about HCL Tech being on a trot, and yes, you've been industry leading in many metrics as well. What do you foresee over the next few years as far as any change expected in strategy? You talked about the acquisition done, and that continues to be part of your growth plans as well. But any change at all that we should expect, or any new levers that you hope to be able to leverage?
So I think, Shireen, actually, even though the last couple of years of the pandemic have been one where everybody had moved to a work-from-home environment, and we were all taking caution on a couple of our expenditure and how the company was evolving, I think one of the things that you've seen is that for us, we've really ramped up and continue to ramp up the pyramid mix. So the number of freshers that we're hiring. And I think that's also now starting to show in the way we're improving our margins. And that's a strategic direction we want to continue taking. What we've done over the last couple of years and continue to do even now is we've opened quite a few nearshore delivery centers. So, you know, we've got Morocco, we've got Vietnam, we've got Sri Lanka. Despite, you know, the economic turmoil in Sri Lanka, there wasn't a day of billing we lost. You know, there's Mexico, there's Costa Rica. So there are many of these new centers that we're opening. So again, expanding on the nearshore delivery model is something that we're going to continue to pursue. And that will also help us in our select geographies to be a preferred digital partner for G2000 companies, you know, work on becoming the preferred employer. You know, where you would have read, we're also experimenting with a lot more unique talent pools, like our Tech B program, which is a grade 12 program, which has now grown to 8,000. So it's a very large number. So I think that we're trying some of these innovations, and I think they're tying into our overall strategy to lead through differentiated growth.
How aggressively do you intend to move as far as this remote delivery model is concerned, and are there any specific geographies that you intend to focus on for the same?
So again, I think that it's in a lot of these geographies, they're a lot more customer driven. So when we look at a Mexico, we look at Costa Rica, we've scaled to more than about 1,500 people, and that's also driven by demand and by customers. So I think a lot of this is demand driven. In a geography like Morocco, we were identifying geographies where we had talent, and how do we go there proactively. So it's going to be a balance between demand driven and lead customers, as well as, you know, pockets where you have talent. But of course, there's no scale like India.
All right, that is the management of HCL Tech speaking to us at Davos. The market, by the way, has really cut its losses. We're just around 25 points in the red. And the mid-cap index also moved into the green, and we're absolutely flat right now. We'll talk more about that, but for now, let's get into a short break. As we do that, here's some important information for our viewers. Don't miss out on the must-have 19 stocks for 2023. Subscribe to Money Control Pro for the full list. Welcome back. You're still tuned in to Trading Hour. And since we're at the start of the earnings season, let's bring you our special segment, Quarter Se Quarter Tak. Vahishta standing by at the wall to take us through all of the expectations from the consumer durable sector in this quarter. Vahishta.
The consumer durable industry faced a double whammy in Q3 of FY23. One being the input price inflation, and second being the muted volume growth. The demand slowdown was largely pronounced in the rural segment of India and at the bottom of pyramid of urban India. A warmer start to winter this quarter has created some impact on the offtake of seasonal products. Now, seasonally, third quarter is an off-season, and hence the AC volumes are expected to be largely flat. Volta's top line could grow at meager 5%, and margins are likely to decline by 200 basis points. In fact, Nomura expects about 2.5 lakh units of primary AC sales for Voltas, resulting in a flat year-on-year revenue growth in its unitary cooling products division. For Blue Star, though, Q3 performance is expected to be supported by market share improvement led by distribution expansion and product portfolio revamp. Now moving on to the small appliances segment. Various channel checks have indicated a destocking in fans and ACs as trade channels prepared for the new BEE, that is Bureau of Energy Efficiency norms. Crompton is expected to post 18% growth in its top line, mainly led by good performance of the acquired Butterfly brand, while lighting and ECD segment could witness some pressure. For Havells, though, with price hikes reversing, expectations are of some risk to the value growth, and thus expecting an 11% growth in its revenues. The outlook for contract manufacturers like Amber Enterprises looks a bit cautious this quarter due to the discretionary slowdown both domestically as well as globally in the smartphone sales. While for Dixon Technologies, the revenue scale-up of new categories such as laptops, refrigerators, and also client editions remains a key monitorable. To summarize, a feeble demand is expected to weigh on the growth of consumer durables industry in Q3 of FY23. The industry still feels that India is at least 1 quarter away from a full bounce back in demand, although premium categories continue to fare better versus the mass segments today.
All right, Vaishna, thanks a lot for that. With that, it is curtains down on this edition of Trading Hour. Thanks a lot for watching. Stay tuned. Halftime Report is up next.